Today, we are honored to have Michael Mauboussin on the podcast. Michael is a highly regarded educator and author and is one of the most respected voices in the world of value investing. Michael is currently the director of Consilient Research at Counterpoint Global, which is a Morgan Stanley mutual fund. He has been adjunct professor of finance at Columbia Business School since 1993 and received the Dean's Award for Teaching Excellence in 2009 and 2016.
Previously, he was director of research at Blue Mountain Capital, head of global financial strategies at Credit Suisse, and chief investment strategist at Legg Mason Capital Management. He has written 4 books on investing and decision making: The Success Equation, Expectation Investing, More Than You Know, and Think Twice. Michael is a chairman emeritus on the board of Santa Fe Institute and has a following of over 140K on X, which is formerly Twitter, where he's extremely active.
Michael's advice and insights offer immense value to students and you investors, providing a deeper understanding of decision making, behavioral biases, and mental models that drive successful investing. For students, his insights can develop critical thinking skills, improve probabilistic reasoning, and build a strong foundation in financial markets. New investors will gain guidance on avoiding common pitfalls, managing uncertainty, and making more informed, rational decisions. We hope you find this discussion both educational and inspiring as you navigate your own investment journey. So thank you for joining us, Michael. It is an honor to have you on.
Thanks, Amir. Thanks, Owen. Great to be with you guys this afternoon.
So I wanted to start, let's start a little bit back, your early academic interests. So you went to Georgetown and you actually majored in government, if I'm correct. So what was that like? Tell us a little bit about your time there.
Well, it was great. I mean, the first thing I should say to back up one step is that in high school, I was really sort of slotted as a math and science guy. So my guidance counselor really wanted me to go to engineering school. I actually applied and got into a bunch of engineering schools. So, I was a bit of a numbers guy, but then literally my senior year in high school, really enjoyed my economics class, really enjoyed my history class, really enjoyed my English class, and thought I'd like to go study humanities. So I went to Georgetown. The one thing that attracted me is there's a wonderful core curriculum, so you do get exposed to lots of different disciplines, and then settled on studying government, minored in economics. I think the key, I mean, I'm still a big fan of liberal arts thinking, thinking from first principles. I think a lot of what we teach in finance are things that can be picked up. It's not a bad thing to be exposed to when you're younger, but there are things that can be taught. And thinking and writing and those are skills that are lifelong skills that it's also really good to develop when you're in college. So I'm happy about that. And fortunately, at that time, there were training programs on Wall Street, and I was able to apply and get into a training program. So that allowed me to fill in a lot of the gaps in terms of my actual knowledge.
Yeah, so really building those foundational skills and going on to learning a bit more about investments, finance, the industry.
Do you think
Exactly.
that government has a different perspective compared to your colleagues when you were working?
Well, it's a little bit of not knowing what you don't know kind of thing. So when I went onto Wall Street, I found that the language was actually very confusing. Every industry's got its own language and terminology, but I found a lot of confusing. And so rather than, having learned it in the classroom and defaulting to what everybody was saying, it sort of prompted me to think from first principles and say, like, why do we do this? Why does an 18 times PE multiple make sense over here? Why does a 5% free cash flow multiple make sense over there? And so to me, that was the big thing, or, what is a good business? And these are questions that are not always completely answerable through quantitative things. So to me, it was mostly about thinking about first principles.
And I think that could be somewhat, we can see how from that you kind of built your viewpoint that's different from a lot of people, your expectations investing process of asking why instead of just going in. A lot of these people learn these concepts from a young age. They go in and they're like, this means this means that. You ask why. Why is that P multiple justified? And I guess that could have kind of led themselves to your current viewpoint of expectations investing and how you
Yeah, I
develop.
mean, I'll just insert here that, I had a really key moment in my career, which was in my training program. One of my colleagues, Nick Ripistello, still a very dear friend of mine, handed me a copy of Al Rappaport's book, Creating Shareholder Value. And there were three things that came out of that book that remain foundational for me. One is it's not about accounting numbers, but about economic value. And Often accounting numbers and economic value go together, but there are times when they separate, and really focusing on economics is important. The second thing is to really do a thoughtful valuation. You have to understand strategy. And to do strategy well, you have to understand value creation. And those are often taught separately and often, I think, thought about separately. But Rappaport really made the point that they have to be joined at the hip. And then the third point, yes, exactly, Amir, to your point. Chapter 7 of the original book was called Stock Market Signals to Managers. So the target audience was actually executives, but clearly relevant for investors as well. And the point being, what do I have to believe to justify today's stock price? And do I think that, the world will unfold in a better way or a worse way, or gee, it's going to be about right? His interest was mostly from the point of view of capital allocation as a company. But of course, as an investor, it's the same thing. It's buying and holding or selling stocks in order to generate or try to generate excess returns.
Yeah. And after that, you went on to a couple firms, namely Legg Mason, Credit Suisse, and Morgan Stanley. Can you dive in a little bit to your roles there, what you did?
Yeah. So the key thing about I was at Drexel Burnham in that training program. The first part of that was training, which again was remedial for me. So learning, going back to basics of accounting and learning a lot of the lingo of Wall Street, super valuable. But the second thing that was even perhaps more valuable was we rotated through different departments of the firm. And so that gave us exposure to all the trading desks, to investment banking, to research, and so forth. The end goal of that whole process, by the way, was to be a financial advisor. So I'll get to that in just a second. But the beauty of that process is, as a young person, you're getting exposed, and there's an idea called, skill matching, right? Which is figuring out where you think your skills and your interests are best going to align to add value to an organization. And I realized that going through that training program, that equity research was something that made a lot of sense to me. That's why I mentioned this stuff about engineering. So I was comfortable with numbers, but research seemed like perpetually fascinating. And to this day, I would say that's still true. It's strategy, it's economics, it's finance, it's, psychology, right? All this stuff in the mix and stirred up. And so after Drexel training program, I went to be a financial advisor for Drexel for about a year, and I was an absolute failure at this. I mean, I didn't technically get fired, but effectively got fired. And they're like, maybe you should go off and do something different. And I mention that because it's very important that I think there are very few careers that are perfectly linear shots going up. We're all going to have setbacks. But from there, I was determined to get a job in equity research. I did some junior jobs, but then I landed a job at First Boston, which became CS First Boston, then became Credit Suisse. So that was where I became actually a senior analyst following the food industry. So that was my job as an equity research analyst on the sell side at First Boston. And that was fabulous. So I did that for a bunch of different years. But interestingly, because of the Rappaport work, I was going to talk to money managers, and they were like, oh, we're kind of interested in what you think about, General Mills or Campbell Soup, but we're more interested in how you think about valuation. So I spent more and more time talking about that. And eventually one of my bosses came to me and said, it seems like you're spending time doing other stuff. Maybe you should do a different job. So they first made me the product manager, which meant I ran the research call and was in charge theoretically of content distribution of equity research at CSFB. And then eventually they made me in 1999 Chief U.S. Investment Strategist, which many of those jobs are today would be something like, oh, where's the market going to go, or what sector should you overweight? My job was really not that at all. It was really about investment process and trying to help people think about investment process. And I'd really say that even from that moment on, so I call the last 25 years, that's pretty much what I've focused on. 2004, I got the opportunity to work with Bill Miller at Legg Mason Capital Management. Bill at the time was toward the end of a streak of beating the market for 15 years in a row, which had never been done before, and I think will probably never be done again. So just an incredibly successful money manager, and built a great organization. So I was chief investment strategist there, again, working with our team on process, doing research, and then external stuff as well. So from there, I had another brief stint again back at Credit Suisse. And then the last 5 years, I've been at Morgan Stanley Investment Management. Our team's called Counterpoint Global. It's a long-only fundamental team run by Dennis Lynch, who's an awesome guy to work for. And again, kind of a similar role as Legg Mason. So working with our team on process, doing research, which we publish for the world, by the way, and then external things. That would be conferences and client meetings and podcasts with guys like you. So
Yeah.
that's the sweep of what I've been able to do. But day in, day out, it's really a focus on investment process. How do we get better in every phase of being an investor?
And talking about research, for those who don't know, on the 19th, you release probabilities and payoffs, a new paper. And I want to actually just revisit Drexel Burnham really quickly. Do you think that Drexel Burnham at that time, it was before 91 because they collapsed in 91. I'd assume mid 80s, early 80s. Am I correct?
Late
So,
80s, yeah. Mhm.
yeah. So at that, do you think being part of that fast growing kind of bank at that time, which was like the pinnacle of banking at that time, specifically in the high yield department, do you think it aided your growth in your career at any point or your viewpoint or anything like that?
Yeah, for sure, in a couple different ways. So number one, you're exactly right, Amir, just to set the table a little bit, that was the era of Mike Milken and high yield bonds. And that's where the high yield bond market took off. Now, just to be clear, I mean, I started in 1986 and left at the end of 1988. So in the interim were two things that were important. One was the stock market crash of 87. And then Drexel got into a lot of trouble, specifically through Milken. So the firm was under a lot of duress. So a lot of two bad things happened that made it difficult. That said, Drexel had a very different culture. And I think it was a little bit scrappier than sort of the traditional bulge bracket firms. And a lot of equity research I thought was quite creative and quite cash flow oriented, right? Which very much appealed to me and almost gave me a green light to continue to push along these lines of Rappaport. So that was one really big thing. And then I'll mention before going to First Boston, I had a brief stint, less than a year, at County NatWest, which was a British bank. You've never heard of that, probably. You may have heard of NatWest, but County NatWest, what was significant was that when Drexel folded, they hired many of the equity folks from Drexel Burnham. So the sales team, a lot of the analysts, a lot of the traders. And so I basically joined a team as an analyst where I was quite familiar not only with the methodology, but also literally the people who are doing, who are my colleagues. So those are two important stepping stones. I think it was very formative. I always like to say, your first job or first couple of jobs, there's a dimension of social imprinting. It leaves, you learn about how the world works from those jobs. And there's no question that Drexel did that for me. I was obviously a super low person on the totem pole, right? I was like not significant, but you're there, you're learning, you're in the environment, and that was very helpful.
Yeah. So you previously mentioned Alfred Rappaport and Bill Miller as like your mentors. I think there was like an episode, another podcast where you talk about Bill Miller and the food industry. So like what lessons did you really learn from them at your time at Legg Mason and writing the book Expectation Investing with Alfred Rappaport?
Yeah. Well, it's I mean, first of all, Bill Miller is I'll just talk with Bill. He's just an extraordinary guy. And so incredibly well read, very thoughtful, very disciplined. He continues to come to my class, by the way. I teach at Columbia Business School. He's been joining the class for probably 30 years. Just amazing. So to have the opportunity to work with him and to really establish what I think was a really good investment process was a real honor. And the thing that's so impressive about Bill, and he introduced me to the Santa Fe Institute, which is a really cool place, but he's just an extraordinary reader, very thoughtful, and applies those skills really well to the world of investing. Al Rappaport, there's not, I can't say enough. He's been my mentor. He's been my collaborator. He's just an amazing guy. We still talk quite frequently. I first met him in 1991 after I read his book. For me, it was like a thrill. It was like meeting a rock star or something like that. And he invited me to join the faculty at Kellogg for executive programs. So I would go out there once or twice a year and participate in some of the executive programs that he ran, which were super fun. And then in the late 1990s, he's like, maybe we should collaborate on this book to take the ideas from that chapter specifically and broader ideas from creating shareholder value, that book, and apply to the world of investing. So that was Expectations Investing. The first version of that, because there are two editions, came out September 10th, 2001. So you just got to think about that, right?
Yeah,
For you
yeah.
guys that are history, right? So September 10th is a day before 9/11, right? Which is a
Yeah.
national tragedy. And from a market point of view, it was the middle of a 3-year bear market. So when we signed the contract, markets were roaring, the economy was great. And by the time the book came out, it was just like the worst possible timing. So just bad luck. So we, as you guys know, we went back and rewrote that book or did a new version of it 20 years later, which was really cool. So to have another opportunity to work with Al closely, update a bunch of the models, the case studies, and so forth was
Yeah.
really.
I
So
remember.
those are really, I mean, and they're obviously when you've had a career for a long time, they're just people along the way that are really important.
Yeah.
You know, Brady Dugan was the CEO of Credit Suisse. Was very important. Dennis Lynch, the guy who I work for now, he's been very important. So they're innumerable people who have been really important along the way, and just want to make sure that none of us would be where we are without the support of folks around us.
And you glaze over this a little bit in your last when we were talking about Alfred and Bill. But why did you decide to go from, if I'm correct, you joined the Columbia faculty in 93. Why did you decide to go from equity research to more of an academia and then start writing books?
Yeah, I mean it's actually not that big a jump.
Yeah.
So the story is that at First Boston at that time, one of my colleagues who followed the computer stocks was a guy named Charlie Wolf, who had been a tenured professor at Columbia and was a sort of informal scout to try to find people to go teach as adjuncts at Columbia Business School. So there was a pretty close link between Columbia Business School and First Boston. And so Charlie read a bunch of my stuff. We had a bunch of conversations. He said, I think he liked the academic flavor of what I was doing appealed to him to some degree. And he said, you should go teach. So really, I did it. I agreed in a very naive, I didn't really know what I was getting myself into. That, as you pointed out, was 1993. But quickly, I found myself interested in it for a couple of reasons. One is that the very fact of teaching something requires you to understand why you're doing what you're doing. So my initial take was going to be something like, oh, I'm, just watch myself and then make it into some slides and so forth. But it forces a lot of introspection. And then the other thing is you're getting a lot of real-time feedback, right? So these are students who are bright and they're motivated. Many of them want to go into the same industry. And so they're going to push back. So that, as you know, now I'm in my 33rd year of teaching at Columbia Business School, and it's been a very, very important part of what I do. And so what I always like to say is that what I think is the ideal is the best of what academia does and the best of what practitioners do, right? So what is good about academia? Academia is it's rigorous, it's curious, but what's bad about it is it does stuff that may not matter that much. There's a lot of bureaucracy and so forth. What's good about practitioners? You're there to make money, right? You're there to do the job. You're pragmatic. What's bad about it is sometimes you're not rigorous, right? And sometimes you're sloppy thinking and so forth. So can we bring the rigor and interest and curiosity of academia to practitioners and so the practicality and pragmatism to academia and put it into one package? And so I'm not sure I succeed in that, but that's very much what I'm shooting for. And I really do think that understanding theory can make you a better practitioner. I'm a believer in that. And so to the degree to which that's true, having a foot on each of those platforms, I think is really beneficial.
Yeah. And for, let's say someone knows nothing about you, you've written 4 books. Quick breakdown of each of those 4 books and the key concepts in each, if someone knows nothing about you.
Yeah, so expectations investing, we've already touched on it, but basically there are 3 steps in expectations investing. Number one, not that anybody shouldn't buy the book to read it, but here it is in a
We
nutshell.
highly recommend it.
Exactly. Step one is to say what's priced into the stock, right? So as I mentioned before, what do I have to believe, or what does the world believe in order to justify today's stock price? Step two then is to say do strategic and financial analysis to analyze whether that company is going to meet, exceed, or come up short of that set of expectations. So the metaphor might be, step one is how high is the bar set for a high jumper? Step two is how high will the company jump? And then step three is just by definition, buy, sell, or hold, given the first 2 steps. So there's a lot of other stuff in there. We have chapters on capital allocation, buybacks, M&A. Original version, we had a compensation chapter and so forth. But that's the core of what we're talking about in expectations investing. The second book's called More Than You Know. That's a book that it was actually the commercially most successful of the 4. And that's it's a series of 38 essays. What I had done when I was at Credit Suisse was a series that I launched called the Consilient Observer. And by the way, you may have noticed the pieces now are also called the Consilient Observer. So we
Yeah.
we brought back the name. But the Consilient Observer were short essays on various topics, and they were very much meant to go anywhere. So consilient is a word that means unification of knowledge. And the idea is that you can pull threads from different disciplines that allow you to be a more effective investor, but more effective anything. It could be a more effective person, more effective parent, more effective child, whatever it is, student, whatever you want to say. So that's more than you know. And so more than you know doesn't really have a theme per se. It's broken into sections. If you're interested in science or psychology or investment process, you'll find there plenty there to like. But it's a lot of short little chapters. Think Twice is really about decision making, and it's almost a homage to Danny Kahneman, who of course won the Nobel Prize. We lost him, I think, last year. And the idea is that in many sets of circumstances, your mind's going to want to think about a problem one way when there's a better way to think about it. So in those situations, you want to be prepared for them to rise, recognize the situation, and then think twice. And so that's what it does is literally go through these sets of situations where your mind's going to want to go one way when you should go a different way. And then, interestingly, toward the end of that, it's a funny little side story. The original chapter two, when I handed it in, the manuscript in for Think Twice was about skill and luck. And my editor was like, "Oh yeah, that's kind of interesting, but I think it's going to lose people. You know, you could keep it, but put it at the end." So that like it's one of the last chapters of Think Twice is about skill and luck. So I sent it out to a bunch of friends and colleagues and people I respect, and of course they all come back and say, "Oh, it was really great." And they're super nice. Okay, fine. But then a remarkable number of them came back and said, "Oh, but that skill luck stuff. Now that was really cool." So I was like, I knew that was important.
Yeah.
So anyway, I had also at the time, Nassim Taleb had a book called Fooled by Randomness, came out around that time, 2001. Shortly thereafter, a couple years later, Moneyball came out by Michael Lewis, right, about sports. But you know, sports analytics at the end of the day is really trying to discern skill and luck, right? And so there's a lot in there about that same theme. So I was like, you know, clearly luck is really important and all these things that I think are interesting, sports, business, and investing. But I'm not sure anybody's done a super good job of codifying that. And you know, the sports analyst guys are actually probably the closest to doing that. So the success equation is an attempt to really do deep dives into what is skill and skill acquisition, what is luck, it comes in different kind of flavors. So how do we think about luck? And then you know what many other ideas that spill out of this regression toward the mean comes out of this, you know, dealing with these things come out of this. So there's a lot of fun stuff in there about luck and skill. And so those are, yeah, that's it.
Yeah.
Those are the books.
You seem like an avid reader, as you can
Yeah.
tell as your wall. I heard you were reading about like biology at one point and like relation to the stock market. Have you ever found anything like that?
Oh yeah, I mean, I would just say that you know I mentioned I get been involved with the Santa Fe Institute, which is a research institute in New Mexico, dedicated to the study of complex systems. I was introduced to SFI by Bill Miller in the mid 1990s. But part of the reason he thought of introducing me to SFI or the people there was precisely because I was reading a lot and it was a lot in evolutionary theory. And you know, when you think about markets and those kinds of things, there's actually a ton of stuff that's very relevant. You know, things like path dependence, evolution. These are just really interesting ideas. But broadly speaking, I would just say I'm a big fan of this idea of mental models. That was popularized primarily by Charlie Munger, Warren Buffett's former partner at Berkshire Hathaway. And mental models is just sort of a way of thinking about the world, right? But Munger makes this argument, which I find compelling and personally very satisfying, that there are a bunch of mental models in each discipline. And if you learn those mental models, it's almost like filling out your toolbox so that when you are faced with a problem, you have the right tool to pull out of the toolbox to solve the problem, right? So if you only have a hammer or only have a screwdriver, every problem you face, you're going to have to try to use your only tool to solve it, and it's going to be suboptimal. But if you've got a really rich toolbox of these mental models, you're going to be able to match problems with solutions in a way that's much more effective. And you know, it doesn't mean you have to do deep dives and everything. You know, just usually two or three big ideas in most fields carry a lot of the freight. And so I've always been a big fan of that. So biology be one of them, but there are many other things you know, learning about physics and psychology and so forth, and how those things can play into what's important.
So you've been asked this recently on Rational Reminder, but we want to ask it again. It's I think it'd be really important to hear. What do you think dictates the stock price?
Well, at the end of the day, and it's not just the stock price, it's any asset, it's the present value of future cash flows, right? So that's ultimately what matters. That's a complicated game, right? Because you're making forecasts of the future. And, what we know is companies, there's a really interesting paper called Lifetime Earnings where they studied about 16,000 IPOs, initial public offerings since 1975. And it turns out about, 20% of those companies are still around, but 40% of them have been merged or got bought by somebody. And then 40% have gone defunct, delisted for whatever reason. Right. So there are a lot of things that could potentially happen, but that is ultimately the goal. And as a consequence, the fundamental way to do analysis is a discounted cash flow analysis, right? Which is projecting and discounting cash flows into the future. We wrote a piece a few years ago called Everything's a DCF Model. And the argument was whether you're doing venture capital or buyouts or public equities or bonds, it doesn't really make any difference. Everything's a DCF model at the end of the day. So that is, yeah, that's what drives value, I think. And thinking about that every day, um, in the real world, practically speaking, people use heuristics for this, right? Your shorthands. And multiples are a good example. Price to earnings multiple or enterprise value to EBITDA multiples. These are shorthands to reflect the process of discounting cash flows. They can save you some time, but they may not be as accurate. So their shortcomings or biases. But that's what at the end of the day, that's what it's all about. I'll just mention one other thing. I grew up in central New York, Ithaca, which is near Cornell University, and my father was a car dealer. And it's a small bit. He's just a small businessman, and when you run a small business, you are intimately familiar with the fact that your livelihood is the cash that's generated by the business. That's it. There's nothing else that matters. And so that also sort of was a seed that was planted in my mind early on.
Yeah. And to kind of follow up on what you were talking about a little bit earlier, why does free cash flow, you mentioned this a lot, why does free cash flow matter more than earnings? And why is price to earnings ratio an incomplete valuation
Or
metric?
like EV to EBITDA?
Yeah.
Yeah, so the same concept. But so why free cash flow versus earnings per share? Well, the answer is that free cash flow, by the way, can be itself quite misleading. So you have to just be careful about all this stuff, right? So the idea most fundamentally is you want to make investments that earn above the opportunity cost of capital, right? So that is the guiding mantra for all this stuff. So free cash flow is defined as net operating profit after taxes. So basically some measure of earnings minus investment in future growth, right? So if you're earning more than you're investing, you're going to have positive free cash flow. If you're investing more than you're earning, then you're going to have negative free cash flow. Now, just to give you an example, Walmart had negative free cash flow for the first 10 years that it was public. But it was spectacular, right? So they were investing more than they're earning, but they're investing at very high returns. And so even though they had negative free cash flow, it's fabulous, right? You want to do more of that. So there's no right or wrong answer about free cash flow. It's the key is that the investments are earning high returns on capital. And that leads us right into the limitations of price earnings multiples or EV to EBITDA multiples, which is they don't really give you a sense of the reckoning for how much investment you need to generate those earnings or generate that EBITDA. And so as a consequence, it's possible and we showed, to the appendix, I think, of chapter 1 of expectations investing, it's possible to invest in such a way to increase earnings per share, but to destroy value, right? Because you're earning below the cost of capital on your incremental investments. Ditto for EV to EBITDA. So again, as I mentioned at the outset, they often go together. Usually, accounting value and economic value do typically go together, but they can deviate from one another. One area where this is really prominent and very important is actually mergers and acquisitions. So if you see an M&A deal, company A buys company B, the press release will usually say something like this. We are buying company B today. We can't believe we lived this long without them. We love them. It was a perfect fit for us, right? All the accolades. Then the next paragraph will say something like, this acquisition will be accretive to adjusted earnings per share, EBITDA, earnings, whatever, something accretive. And then they'll often give a synergy number, right? So right off the bat, they'll say it's accretive, but it turns out that many of these accretive deals, in fact, the most common, the modal outcome is that a deal is accretive to EPS and destructive of value. Stock goes down, right? And so that just tells you the market's saying this is a net present value calculation, right? You're making an investment in an M&A deal, and we don't think you're going to earn your cost of capital. So your stock is going lower, right? So the market's judgment may or may not be right at the moment, but the market's doing that calculation, and these are often high stakes. So that's a good illustration of why earnings or when earnings go one direction and value goes the other.
Yeah. And moving on a bit from that, you stress the importance of a strong investment process. So can you explain the importance of process over outcomes for our listeners and give maybe an example or two of a couple? Because we see a lot of people, I think specifically our age, who maybe invest in NVIDIA because they heard it was good. They get good returns, and all of a sudden they think they're a hedge fund manager.
Yeah.
Exactly. Well, the thing is, let's go back to the success equation and luck and skill. And one of the key ideas there, and it's very intuitive, is you can draw a continuum on one side, let's say your left, all luck, no skill, right? So think like roulette wheels or lotteries or stuff like that, right? So there's no skill at all. And then on the far right would be all skill, no luck, right? So think, running races or, chess would be over there somewhere, right? And then almost everything interesting in life's between those extremes, but those are the two extremes, right? So if you're on the all skill side, process actually doesn't matter. I mean, all matters is the output, right? So, we all sprint against the world's fastest sprinter. The guy's going to win against us every single time. We don't really know what his process is. All we know is if he runs faster than us, he's going to do it over and over. And that's that we know that his process is better. By contrast, when you move over to the luck side, as you introduce luck and more of it, it turns out process becomes much more important, right? Because you need to repeat a small advantage over time for that skill to surface. And so process becomes more important. So the first thing to say is not just process is more important than outcome in every instance. It's really important when there's a lot of luck involved, which is certainly true for the world of investing. So, that's basically we sort of say, what are the examples? That would be the examples. Think about, one example we talked about a bit too is in sports, right? So there are various statistics in sports. You need to have a sufficient sample size to be able to draw things, but they vary in their degree of skill. Some activities in sports or measures are much more skill oriented than others. So if it's a skill oriented measure, then you don't need as much sample. The outcomes are more reliable with the underlying skill. By contrast, if there's a lot of luck going on, then you need to increase the sample size. You need to focus on process to understand what's going on. So I hope that answers the question, but it's a really important, it's kind of a subtle thing, but it depends on the type of activity that you're in.
Yeah.
And then process really important. And by the way, this is, it's not atypical. People do well, in markets and they think they've got it all figured out. If whenever you hear someone say something like that, I mean, ultimately the greatest investors are going to have a lot of humility because they've been humbled many times along the way. And I think that one of the things we know about investing in particular is that forecasting is inherently extremely difficult to do. The market is smarter than you are. You're going to have opportunities from time to time to step in, and even those you'll succeed with some success rate. But anybody who thinks they've got it licked is probably someone that doesn't know. They haven't been around for very long because it's going to humble everybody sooner or later.
How can investors incorporate a process-driven approach rather than relying on intuition?
Yeah, so this is another one of these big topics about, when does intuition work and when does it not work? And so again, I sometimes people suggest that I don't believe in intuition. I do, but intuition works specifically when two conditions are in place, that you're dealing with a system that's linear and that's structured, right? So a good example would be chess, right? 8x8 board, the pieces move the same way every time. So if you study chess, you go to a grandmaster or master even, they're going to be able to look at a board very quickly, see which player has advantage. They'll be able to figure out close to optimal moves pretty quickly, right? So intuition works very well in these stable and linear systems for sure. When you introduce instability and non-linearities, that's when all bets come off, right? And so again, you could think about markets or forecasting economies or any complex systems, broadly speaking, they're going to be inherently unstable and nonlinear. And as a consequence, your intuition is going to tend to serve you quite poorly. So yeah, we wrote a piece about this and it was about pattern. We specifically talked about pattern recognition. And again, pattern recognition is going to work really well in some domains and it's going to work really poorly in others. And so interestingly, just as a little history on this, that there were sort of two camps in psychology on this. One was Danny Kahneman, who's sort of the anti-intuition guy, and the other was Gary Klein, a psychologist who was sort of the pro-intuition guy. And they decided to do what's called adversarial collaboration. They wanted to work together to see if they could hammer something out. In effect, what they came back with was intuition works, but very domain specific. So I think that the
Yeah.
mistake people make is that they tend to overextend the boundaries of where intuition works. And the last thing I'll say is, and this is problem is like storytelling. So you'll hear a story like, oh, this guy was in the shower and he thought up this great business plan. Then he went out and did it and made $1 zillion, right? So like this bolt of lightning intuition came to him, right? But you don't hear about all the people who are in the shower who had an idea that failed, right? So
Yeah.
so you only see the successes, you don't see the failures. So you have to be very measured about that stuff. So yeah, I think intuition is a real thing, but it's also qualified.
Of course. Yeah. So what are some skills and mindsets that you think that people should develop if they want to have a career in equities?
Well, there are a few things that are really important. One is you have to, notwithstanding my lack of understanding of all these things, when I joined Wall Street, there are certain basics you have to understand. So one is I would call it numeracy. So being comfortable with numbers is really important. You don't have to be a math major, but being comfortable with numbers is really important. Learning accounting is really important. So accounting is the language of business. I think it's a very exciting time in many ways in accounting because accounting is lagging what's happening in the world, specifically that accounting was built in a world where there are mostly tangible assets. So think, factories and machines. And we're moving rapidly to a world where it's intangible, like much of the stuff you guys deal with, so software and all, intangible stuff. And that doesn't really, the accountants struggle to deal with that. So that's exciting. I think you have to think probabilistically. We already talked a bit about that. So understanding that everything is a probabilistic bet, everything's an expected value bet. I do think you have to understand markets. So if you think that you know something that the world doesn't know, so there's an inefficiency of some sort, why is efficiency being constrained is a really important question to pose and to answer. So in other words, who's on the other side of my trade, right? So I decide to sell NVIDIA to Amir or Owen. Why, why do you guys buy it when I
Yeah.
sell it,
Yeah.
right? So like, what do you know that I don't know? And again, having a bunch of humility about that would be important. But I think if I were to underscore Owen, if I were to say like one thing that I think is universal in a lot of the great investors that I know is a deep sense of curiosity, just asking a lot of questions. Most really good investors are really avid readers, and that reading is mostly to satisfy their curiosity. And so you'll see them interested in a lot of different stuff, but you also see them almost without fail that they're very deep and avid readers. And that's just a curiosity thing. So I think those are a few things that I would tick off. I mean, by the way, you mentioned equities, but it doesn't matter. It could be anything, right?
Yeah.
It could be credit, it could be anything. It's all the same. It's the same thing. Venture capitalists. I mean, the best venture capitalists I know are inherently very curious people. Go right down the line. Yeah.
Yeah. Clearly, it seems like you've read a lot of books. Do you have any
Yeah.
favorite books you have there?
Yeah, it depends. I mean, the problem is all that question like that is it depends a lot on what you're interested
How
in.
about
And
like, let's give it back to high school. What would you say, like a book a high schooler, like your favorite choice for them would be?
Yeah, I wish I had the list. I tweeted about this a few years ago. My oldest son did a gap year between high school and college, and I gave him a list of 10 books to read. And I think those would be the 10 books I would probably even today would recommend. So I know you guys could probably track down that tweet somewhere where I could
Yeah,
track it down, but
we
but
will.
that would be it. But a couple of them come to mind. Peter Bernstein wrote a book called Against the Gods: The Remarkable Story of Risk. Peter Bernstein was an economic historian, a commentator, but a really beautiful writer. And why I love that book is he goes back and understand the history of our human understanding of risk, and it gets into probability. And you realize that risk and even probability are quite contemporary concepts, actually, in the scheme of human knowledge. Um, we've used the term consilient a bunch of times. E.O. Wilson wrote a book called that came from where my inspiration was a book by E.O. Wilson, a very famous biologist, called Consilience. So consilience, the basic theme there is that much of academia has been very siloed, and that many of the vexing problems in the world problems that your generation will certainly face, so think about climate and so forth, are actually at the intersection of disciplines. And as a consequence, it's a big urging for us to learn about different disciplines and to work together to try to solve some of these problems. Um, I love, I mentioned a bunch of times the Santa Fe Institute. There's a wonderful book that's now old, but still, I find it almost exhilarating to read called Complexity by Mitchell Waldrop. And it's the story of the founding of the Santa Fe Institute. And if nothing else, I mean, there are a lot of interesting intellectual ideas, but this feeling of excitement of learning and working in new fields, I think, is also something that's quite contagious. So those are a few
Yeah.
that come off the top of my head. But yeah, we'll track that. Collectively we'll track down that list and see if we
Yeah,
can
we will.
share that.
And these are two questions we ask every guest at the end of each interview. So if you had to give one piece of advice to your high school self, what would it be?
Study more. No, I think that I don't know if I really regret that, but the it's interesting that even in high school, I started to spend more time with like the smarter kids in my class, and I think that paid off a lot. I played sports in college, just played a lot of sports in high school, and so I probably wasn't the most studious guy as studious as I should have been. Um, and then the other thing is, I think that I mentioned before this concept of skill matching, but the sooner you do that, the better off I think you are, which is even when you're fairly young, taking inventory of what you're good at, what kinds of things you enjoy doing, um, is really helpful. And then kind of thinking about what kinds of opportunities in the world fit where you can add value. And the thing is about even jobs, the key is really figuring out where you can be valuable to an organization for them to pay you, right? It's not just getting a job, it's where you're adding value and you're contributing in a meaningful way. The other thing I'll say when you go off to college, there are probably two bits of advice I would give to college students, which I didn't do as certainly as well as I should have. Number one is don't hesitate to take courses that are outside, what you think you find interesting, right? So go through the course catalog and find something unusual, something you would normally not do, and get after it, right? Because it's an extraordinary opportunity to learn from typically great professors. And then the other thing is, last thing is, get to know your professors. There's a long study at Harvard about successful college careers, and there are 8 specific things, but one of them is to get to know your professors. And so if you shot for getting to know one professor per semester, and you're there for 8 semesters, that would be 8 professors. And even if you batted 500, you get to know 4 professors, right?
Yeah.
And that's great for, whether you need a recommendation for graduate school or just someone to stay in contact with. I think that's advice I would love to have heard and taken more seriously
You
myself.
tell your students that.
Yeah.
Yeah, yeah. I do tell my students to stay in touch, and it's very, very fun and gratifying to hear from students over the years. Two I'll mention that were actually, both played prominent roles over the past weekend. One is Todd Combs, who now works with Warren Buffett at Berkshire Hathaway. Todd took my class in 2002,
They
and
publish a lot.
he was, he got a shout out about, the performance of Geico and the Berkshire Hathaway letter. But Todd is a guy who also stayed in touch. And so, really feels, I mean, it's amazing. I'm thrilled at how successful he's been. He's been super busy. Another one I'll mention is Karen Langley. She's works at the Wall Street Journal. So if you read these Berkshire Hathaway articles about Buffett and their cash balances and the Buffett family and so forth, the last interview I think in the media was with Charlie Munger was from Karen. So she's now really doing a lot of great work on covering Berkshire Hathaway. And again, she was a student. She was a journalism, she was a journalist. But a super talented student, and it's awesome to be able to work with someone like that to convey ideas to the world of finance and hopefully make her a better journalist as she goes out there.
So we always ask this question. What is one question you don't think you're ever asked that you wish you were?
Well, I don't I don't have an answer to that. No, I don't. I just don't know. I don't know. What do people say to that? I don't know. Yeah, I mean, it's funny because I think that the thing that I spent a lot of time in my youth and even through college in playing sports and in athletics.
Yeah.
And I think that part, like, so people that knew me when I was young probably think of me more as a guy that was into sports and a guy that was into anything intellectual. And now people think I'm more into intellectual stuff. So that might be the one thing that maybe is not as well known. But
The
yeah,
funniest one we got was Jim Rogers. He just wanted a hot tip.
yeah, exactly.
Yeah.
That's not a bad way to go, actually.
But thank you so much for coming on, Michael. We
Yeah.
really appreciate it. We
Thank
know
you
your
very
time is
much.
valuable, and I'm sure you've a lot of high schoolers, a lot of students have gained a lot of value from this podcast. So thank you.
Thank you guys, Amir. Owen, really great to be with you today.
Yep.
Appreciate it.
Thank you very
Bye.
much.